You make $250,000 a year or more, and every April you feel like you got punched in the gut? Here's the truth. After helping over 250 clients save over $10 million in the past trailing 12 months, I can tell you it's not your lifestyle, it's not your paycheck, it is your system. We're going to break down different levels, and right now you're running at a level 1 tax plan. You hand numbers to your CPA, you hope for the best, and you watch $50,000 to $100,000 of your hard-earned money disappear. I'm not here to bash CPAs. Most are excellent at filing. But filing is not saving and it is not building wealth. In this video, I'll show you the new way to cut $50,000 off your tax bill in the next 12 months. Legally, of course, ethically, and without changing your CPA, using 3 simple levels. So level 1, reactive filing. This is what 99% of high W-2 income earners do. Level 2, strategic deductions, side income, HSA stacking, real estate depreciation, real estate layering, S-Corp conversions, and retirement conversions. And then you have level 3. This is where you really deserve to be. Tax design, with the right entity structuring, the proper wealth planning, focusing on bonus depreciation, having audit-proof records, and engaging charity. I'll break down why the compliance model keeps you reactive and overpaying taxes, and a 5-minute test to find your leaks in your strategy. We assist in plugging these leaks before your next filing deadline. So if you're ready to stop donating your hard-earned money to the IRS and you want to keep more of what you earn, let's get to work. First, let's map out the game plan. There are 3 levels, and most high earners are stuck at level 1, reactive filing. You hand your numbers to your CPA and you're hoping for the best, meaning there's zero strategy, no timing, and no real design. Here's what it looks like. You hand over your W-2s, K-1s, any 1099s. There's no documented plan, no timing decisions, and no entity analysis. You just file, let's be safe, give me a few $1,000 on my refund, I'm happy. Why this hurts you more than you think? Well, W-2 income gets the worst tax treatment, the highest tax rates, the fewest deductions, and no control over when your income actually hits, how it's characterized, or where it lands. Let's trans that into take-home reality. Here's what these brackets typically mean. If you're earning $250,000 as a W-2 employee and there's no state tax, your effective tax is around 24 to 28%. Your marginal rate is 32 to 35%. Imagine you're a W-2 earner earning $250,000 a year in a state that has taxes, 5 to 10%. Your effective tax rate now becomes 26 to 30%. Your marginal rate is anywhere from 36 to 41%. Now take a $500,000 earner, high tax state, effective tax rates 32 to 35% plus an additional state, city tax. We're talking almost 45 upwards to 50% taxes. There's no recharacterizing your pay. Salary versus distributions, for example. No front-loading depreciation or bonus depreciation, section 179. There's very limited pre-tax deductions, almost no timing control. You work, you pay taxes, and then you get your cash after the fact. So what's the result? You're leaking 50 to hundreds of thousands of dollars out of your bucket, and you're losing the years of compounding growth on that money. So this is level 1. And as you can see, this leaves you exposed, no control, no timing, no leverage, no real wealth accumulation. So let's stop to level 2 and start engineering deductions that flip the math. Again, I'll use software engineers as the example so you can see it in action. Let's say you start a simple side business. That becomes the gateway. You form a legit LLC for consulting, code reviewing, architecture audits, additional CTO consulting work. That unlocks business write-offs that you can take as a pure W-2. Easy common write-offs such as your laptop, a monitor, your cell phone, internet, used for client work, paying your kids for legit work in the business, development in AI tools, Copilot, ChatGPT, JetBrains, small cloud spend for demos, domain and hosting, security keys, Zoom, Calendly softwares, business travel, and of course you want to keep agendas and write down purpose of all of these business trips. And having a true home office, exclusive for regular use. Here's just a little pro tip. Save your invoices and receipts. Track the mileage. If you later select S Corporation, structure a simple accountable plan to reimburse yourself pre-tax. Max the tax advantage buckets. Use a family HSA if you're eligible. Pre-tax, tax-free growth, tax-free qualified medical out. If your LLC starts earning real profit, consider an S-Corp when it makes sense. Pay a reasonable salary. Take the rest as distributions and reimburse expenses pre-tax via the accountable plan. Add real estate into your portfolio only if it fits your life. Short-term rental only if you material participate at least 100 hours, your average stay is 7 days or less, and you properly document these losses, you could offset hundreds of thousands of dollars in W-2 income. Cost segregation and bonus depreciation when appropriate. Break down the property into 5, 7, 15 years to front load depreciation and increase deductions now. You can use timing to stack savings in big income years. So what does that look like? A donor advised fund. Bunch multiple years of charitable giving into one high income year. Prepay legit expenses before the end of the year when it helps. Section 179, bonus depreciation. Accelerate write-offs on qualifying equipment that's placed in service and used 50% of the time for business or more. Level 2 will stop the bleeding. It creates write-offs, timing, better buckets. Now let's lock it in so the savings repeat year after year. Now we're on to level 3, which is the ultimate level, tax design, the structure that makes strategy automatic. We start with the foundation, entity architecture. Keep your W-2, run a legit side business, select S Corporation when the math works out and supports it. Use clean holding LLCs for rental properties. Create a holding company in Wyoming. Why this matters is it unlocks levers. You can take distributions versus salaries. You can have the accountable plan for reimbursements. Create the Augusta rule and rent your house out and create the income tax free, but take the business losses. Clean retirement contributions and having audit ready books. So you have the peace of mind. So next in tax design is wealth routing, paying yourself the smart way. I've talked about the S-Corp. Pay yourself a reasonable compensation, take the rest as distributions. Eliminate FICA taxes immediately. Flow dollars through a pre-tax 401k, HSA, tax-free account. You could focus on a Roth, backdoor Roth, and mega Roth. Different buckets there as well. Coordinate employer benefits with your own plan to avoid overlap. The result, lower payroll tax, more compounding, more controlled cash flow. I know that sounds better than what you're currently doing. Consider cost segregation studies and bonus depreciation if real estate fits into your portfolio and if it makes sense. Use cost segregation to identify the 5, 7, 15-year components in the property. You can front load the depreciation to offset high income tax years. It works with short-term rentals, the material participation, or if you have a spouse who qualifies as real estate professional. Big legitimate deductions now, not over the next 30 years. Now focus on having an audit-proof system so your savings stick. Some things there are very detailed minute meetings and resolutions, keeping all of your receipts, tracking mileage and participation logs, focusing on fair market value pay if you're paying your kids. Have clean paper trails. This is going to give you the confidence when filing, create smoother audits, and create durable savings for you long term. Here's a quick reality check. None of this survives a once-a-year race to file. The issue is not your CPA skills. It's, of course, the workflow and the system you are currently operating out of. So think about filing taxes as scorekeeping in baseball. The scorekeeper is not the coach. They track the data, right? The coach drives the plan. The coach helps execute the plan to win. A coach creates a customized plan and design on how you can win every single year, year after year. So again, just from point number 1, your CPA is not broken, but your model may be what's actually wrong. You have the wrong expectations of the scorekeeper and how to actually win and keep your tax dollars. If you only file, you're forfeiting. The filing only model is why high W-2 income earners just like you are overpaying hundreds of thousands of dollars in taxes every single year. And again, that is the compounding growth that we have to consider. So a few things your CPA will actually do well is they will keep you compliant most of the time. They file under a brutal 12-week period. And they minimize risks on what's already happened for you. Well, what's missing is the true wealth design. Filing is scorekeeping, strategy is coaching. And because these are two so very different and different jobs, I cannot reiterate this enough to you how important it is to have a coach in your corner. So here are a few steps you can follow to save $50,000 to $100,000 this year. Add a legitimate side income, a side LLC to unlock ordinary and necessary deductions using Section 162A. Max tax advantage accounts you qualify for. Your 401ks, your HSA, traditional IRAs, backdoor Roth conversions. Use a written plan for timing. Bunch donor advised funds. Create legit expenses. Place equipment into service before the year ends. Layer in real estate when it's appropriate. Understand the difference from long-term rental, short-term rental, and how to qualify qualify as a real estate professional and implementing the cost segregation to accelerate bonus depreciation and apply these benefits. Choose the right entity for your side income, LLC versus S corporation, payroll versus distributions, and when it makes sense for you. And document everything by default. Your accountable plan, mileage logs, home office logs, receipts, paying your children, participation records, the Augusta rule, and run quarterly check-ins every single quarter, not to just meet, but to adjust, to adapt, to come up with the best game plans. Coordinate with your CPA so they file smarter. Create an audit-ready return. You can consider doing this solo on your own, and you could get stuck, you could miss timing windows, and that's why you could leave $50,000 to $100,000 on the table this year. And it's not hypothetical, it happens way too often. That is why my company exists. In the last 12 months, we've helped 250 clients keep over $10 million that they would have otherwise paid in taxes. You could plug into the same system they used. You could 3x your returns this year by utilizing our secret tax return system that the ultra wealthy are taking advantage of. You do not have to fire your CPA. We are willing to partner with you and your professional. You do not require a lifestyle overhaul, just layered strategy that fits your life. No hours buried in spreadsheets. We handle the heavy lifting. So if you're a high earner, earning over $250,000 a year, and you want to 3x your tax return and possibly save 50, 100, even hundreds of thousands of dollars in your pocket, hit the top link in the description. Book your call and see exactly how we can help. Spaces are limited, so make this decision quick. Are you not quite ready to book? No problem. Let me show you a few things that our clients are doing to lower their tax bill and how you can do it yourself as well. Number one, start a business with an LLC. Like I shared in the first video point, that unlocks business write-offs you can't take as pure W-2. Example, your laptop, pro software AI tools, licensing and fees, a true home office, your internet and phone bill, travel for work, marketing, meals, bookkeeping, the list goes on and on. Max your tax advantage buckets, control your payroll, use the family HSA if you're eligible. If you earn side income, consider the S corporation that can pay you a reasonable salary. Take the rest as distributions and reimburse expenses through an accountable plan. Use timing and bunching big income years using donor advised funds. Prepay legit business expenses and use in Section 179 or bonus depreciation on qualifying equipment that's placed into service and used mostly for business the year of. And if these three moves sounded like work, you're probably thinking, I'm just too busy. And that's the exact thought that keeps high earners just like you overpaying 50 and hundreds of thousands of dollars a year. So let me show you why too busy is the most expensive thing and the most expensive decision you can make. Here's the truth in plain English. If you do nothing, you stay a W-2 earner, the government gets a bigger raise every year than you do. Run the math. A realistic plan that saves you $50,000 this year in taxes. Fast forward 3 years, that's $150,000 gone before compounding interest. Now zoom out. If you take that $150,000 and you invest it into savings and you're creating 7 to 8% in a simple index fund, this is going to create over 7 figures in future wealth. So you're walking away from potentially 7 figures by not making a decision today. So what's the time cost? How much do you have to actually invest with your time? It's not as much as you think. We do front load design in 60 to 90 minutes with you. We have a handful of one-on-one sessions. We're meeting once a quarter to make sure that you're getting done what's required. We put a few high leverage moves onto your calendar so you can achieve what you require automatically. Every month you wait is another month of avoidable tax and loss compounding. So before we go further, let's get a baseline. If you can't measure the leak, you cannot fix it. Take the 60-second check with me right now. Let's see if you're leaking anything out of your bucket. And every time you say yes, lift a finger on one hand. If you hit 2 or more, you need to act this quarter and now. Not next year, not when you get to it, now. You only meet with your CPA during tax season. You have no written tax plan for the year. Your income is only W-2 or straight K-1. You assume if it mattered, my CPA would bring it to me. You're planning to fix it next year and you'll get around to it. Now score it. If you're at a 0 to 1, you're ahead. Refine, document, maybe change very little. 2 to 3, you're leaking $25,000 to $75,000 a year. And if you had 4 to 5, you are leaking 50 to hundreds of thousands of dollars a year. And you deserve a design plan. So if that simple checklist flagged a leak in your bucket, don't stress. Most high W-2 income earners are in the same spot. So the good news is it's fixable without changing your CPA or your lifestyle. If you want help mapping the smartest next moves, hit the top link in the description. description. We'll look at the numbers, outline how the tax return system could 3x your tax return this year. No pressure, just to give you clarity. And if you prefer to keep learning first, watch the video on the screen, check out the next video, subscribe to my channel, give me a like and a thumbs up, and don't miss my weekly breakdowns. Take care.